All right, good morning, everybody. I'm Katie here at OAR, and with me I have Toya Butler.
Good morning, Katie.
Good morning.
Shall I just kick it off?
Yes.
All right, here we go. Oh, welcome, everybody. I am very happy to be speaking with you today about 1031 exchanges. As I tell people, my favorite topic. And the outline that we have today is 1031 soup to nuts. And we're going to cover the gamut. We're going to start with the fundamentals of 1031, work through a few advanced issues. We will talk about reverse exchanges. We will talk about improvement exchanges. Those are a lot of questions in our office these days about those topics. So this is a presentation that is really good for, well, anybody who's listening, folks who perhaps have never attended or heard a 1031 presentation, and those that have heard a number of them. We are really going to give you a refresher on 1031. I'd like to say, first of all, that again, I'm Toya Butler. I am an attorney, real estate attorney, and 1031 is tax law, and I'm not a tax attorney, but I have done this work now 28 years, and so I have a pretty good handle even on the tax issues that surround 1031 exchange, but I am technically a real estate attorney. I would say that in the time I've been doing this work, we have, and across my desk, over 20,000 exchanges. Our work isn't exclusively Oregon. We do work all over the country, frankly, but 20,000 exchanges that I bring to this discussion today. And I hope to some degree it is a discussion. I do welcome your questions. And you may notice that she's talking too fast, and that is the way she is wired. I am here without any caffeine or chocolate. So if I have gone too fast for you, would you please ask a question? Katie will put that to me and we'll clarify, or I'll play the tape a little more slowly. So we will move pretty quickly today. Volume. I just wanted to mention, what are we seeing in the way of 1031 activity? And in our office, we have been averaging, frankly, for the last 3 years, averaging 100 or more exchanges a month. So, and now for us, that's going to be 100 or so sales, and then, 100 or so purchases. So over 200 transactions in our office, and we've got a team of 7 in there moving very quickly to take care of all of these transactions. So we are seeing 1031s. They continue at a high rate, frankly, and we don't see any slowdown coming here in 2020 based on our phone activity just this month. So you are very likely in your work in the coming year to encounter a circumstance that may in fact be a 1031 exchange or may at least be worth exploring. So that's the volume in our office. Again, we're going to cover the fundamentals today, get into some advanced issues. And one thing before I start, I hope that I have a 4-page questionnaire describing the mechanics of a 1031. Now that is linear for your client. Step 1, step 2, step 3, and on down the line of what they have to do to have a good exchange. So after this presentation today, you might scan through that and it would hopefully put the material we're covering today in context, linear. My presentation today is not what you would consider to be linear. So moving first to the terminology and the words that I'm going to use today. I will call these a 1031 or an exchange. They come out of Section 1031 of the Internal Revenue Code. And may I say, 1031 has been in the code now 99 years. Next year, swing by our office and you will see an ugly banner hung up celebrating the centennial. I am determined. 99 years, and for very good reason. And we will talk about that in a moment. I'll call it a 1031 or an exchange. You see there, tax deferred, sure. Tax free, like kind, starker. And people sometimes, especially here in the Valley, think starker is something else. But no, a starker is an exchange. These are all good terms. Use any that you're comfortable with. I'll be using 1031 or exchange. I call our client, our mutual client, the exchanger. They're going to be selling the relinquished property. Oh, see there, I know terminology, relinquished property. They're going to be buying the replacement property. They're technically doing the exchange. So we call them the exchanger. I'll refer to companies such as mine as the accommodator or the exchange company. you can call us a facilitator, intermediary. The IRS term is a qualified intermediary, but I find that to be too many syllables. So I will simply call us the accommodator or the exchange company. Why do a 1031 exchange? What's the point? The primary reason for a 1031 exchange is that your client is selling a property that has appreciated over time. It has gain, and they don't want to pay tax on the gain. In 1031, if they get out there with you, find and buy a replacement property, work with a company like us, follow a bunch of rules, the gain in the old property doesn't go away. It moves to the replacement property. Deferred. Technically a tax deferral. Second tax benefit, there's a double tax benefit with 1031. One, they don't pay tax on the gain now. Second benefit, if they are selling an improved property, a residential rental, a commercial property, they will have taken depreciation deductions in that over the course of time. With a 1031 exchange, not only does the gain move to the new property, but the depreciation schedule moves to the new property. Keep in mind, if your client's selling a residential rental, for instance, and it's got gain, and it has depreciation deductions, if they just sell that property, they have to pay tax on the gain. They have to recapture the depreciation deductions. And here in Oregon, our clients are taxable both federally and at the state, of course, unlike my clients out of Washington state that only have federal taxes. Here, we've got federal and state. And the good news is, most states follow federal. So my client doing an exchange here in Oregon will not pay the feds, and they won't pay the state of Oregon. Not now. The gain goes to the new property. The depreciation schedule also moves to the new property. In most instances, they will have a double tax savings. You know, what's the real fundamental benefit to them? It leaves more dollars in their pocket, so to speak, to leverage into a bigger and better replacement property. And so most of my clients, the younger investors, are looking to build wealth through investing in real estate. They sell the single family rental to buy a duplex. A few years later, they leverage those tax dollars into a fourplex, and then later an eightplex, and eventually the 30-unit apartment building. So my younger investor is using 1031, essentially using what would have been tax dollars peeled off to the state and feds to get into bigger and better replacement property, building wealth through investing in real estate. What qualifies for 1031 exchange? And this is critical, frankly. There's two things that I will need you to know at the end of this class. There's no test, of course, but there's two things that I do need you to know, nothing else. You can forget everything else in this outline, but two things. I need you, one, to be able to spot the opportunity for an exchange. And number two, I will want you to know that we're a resource for you, for your client. The top attorneys in this state and CPAs and commercial brokers and lenders, they all call with questions about 1031. We're always a resource for your circumstance, your client's circumstance. So one, spot the opportunity. Two, know that we're a resource. Well, where would you spot an opportunity for exchange? And here we are on what qualifies for 1031 exchange. Only three types of real estate: residential rentals, commercial properties, and land that's been held for investment. So that would be typically ag land, timber land. Sometimes we do see people who land bank outside the urban growth boundary, anticipating the day when the boundary will bump out. So it's for only three types of real estate: residential rental, commercial properties, and land held for investment. Well, when do you spot the opportunity for an exchange? When you are in a listing appointment and you are talking to a potential seller about the sale of a property that is either a rental or a commercial property or land that's been held for investment. I should say this: you might be taking a listing of their own home where there's a rental unit, their own home where there's a shop out back and he has a landscape maintenance business back there. Land, they're sitting on a 20-acre parcel out in Molalla. House is on 1 acre of that, and there's 19 acres of timberland or ag land or whatever. And that 19 acres of the 20 is land held for investment. So when you're in a listing appointment and you see a property that is in whole or in part, rental, commercial, land, That's the opportunity for an exchange. We will not know if it's a good opportunity until the client starts down that checklist that I provided, and they get to their accountant, step 2, and they talk to us, step 3. And after that conversation, maybe they talk to us first and then they talk to the accountant, either way. But once they've consulted with their team, professional team, then it will be determined if a 1031 is a good opportunity. But if I may say, you, the broker, are on the scene, the first one on the scene of a potential sale. Every sale is potentially taxable. And so the sooner you can spot that opportunity and point them out toward resources, the better decisions your client will make as to whether 1031 is even useful or not. And also, I should say that half of the calls that I get at my desk will not turn into a 1031. Once we've held the conversation, the client either determines they don't want to do it, or we determine that it isn't doable. Half of the time, 1031 will not get them to whatever their goals are in life. But I need you to spot that opportunity if you would, because you're the first one in that listing discussion, in whole or in part, rental, commercial, or land held for investment. And what is like kind? This is the best rule that we have. All real estate is like kind, as long as what they buy is also either land held for investment or a commercial property or residential rental. No offense to the accountants that won't be listening, but you might know, and a lot of one in your family. When my client calls me and they've been to the accountant, they are a little stressed out sometimes because they have come away from their meeting with the accountant with the understanding that like kind means that if they're selling a 3-bedroom, 2-bath pink house, they have to go out and buy a 3-bedroom, 2-bath pink house, and they don't want a pink house. And the good news is that's not the rule. The like kind rule is so generous. Frankly, when we are talking to folks and they don't, they're vague and hesitant and don't, I will say to them, in a 1031, you have to buy real estate. If you have to buy real estate, what kind of real estate do you even want? Now, if they say no real estate, then 1031 won't help. But what kind of real estate do you even want? And we can buy almost anything they want, as long as they're willing to follow some rules. So it's rental, commercial, or land for land or commercial or rental. What do they want? Very, very generous like kind definition. Now, what doesn't work in 1031? What are non-qualified properties? And you'll see second homes. A second home, although the owner might feel that's a good investment, it's not the IRS definition of investment. So they don't work. Inventory. What's inventory? New construction by a builder, that's how they make a living. It's ordinary income. They have to pay the tax on the profit in the sale of new construction. 1031 is only for capital gain income, not ordinary. So new construction by a builder, new lots created by a developer, nope, that's inventory. And flipping. So if you have a client that likes to buy properties to fix to sell, that's inventory. It's not a rental. 1031's for rental properties. Now, if they want to convert the flip into a rental and wait a while, yada, yada, they might be able to get themselves eligible for 1031, but at the outset, flips don't qualify. Primary residences don't, except, okay, so first of all, primary residence, your client's selling that, and perhaps they do have a spouse. Then from the sale of their own home, I know you're aware, they get $250,000 of gain tax-free each. So for a couple, $500,000 tax-free from the sale of the primary. Except, well, what's that except about? When, as we mentioned a moment ago, it's their own home where there's a rental unit, their own home where there's that commercial activity, their own home where there's land. In which case we can do an exchange out of that mixed use property, the rental portion only, the commercial portion only, the land only. They still get the tax-free for the primary residence portion. Now I want to go back to second homes. And I do want to share with you what is the most common scenario that we see in our office. Katie, I want to double check. Are they able to hear me well? We're good on sound, are we? I'm seeing that my microphone says I'm on mute.
Oh, yes, yeah.
We're totally good.
Here.
Okay, we're very good. Okay, just want to double check that you can hear me. Second homes. I want to talk about what is the most popular technique or strategy in our office. So we have a client who doesn't want real estate, but they wouldn't mind a place in the sun. And have we had the calls, especially here in January? They want to buy in Palm Springs, they want to buy in Palm Desert, Phoenix in third place, Maui, okay. Beach, not so popular here in January, but they want something that would eventually be a second home, or perhaps even a retirement place that they would retire into the sun in Phoenix. So honestly, about a third of our exchanges, our clients are buying a rental, because it must be a rental, and eventually they will convert that to a second home. And the IRS and Congress are aware that 1031 is used to buy properties that will eventually be personal use, second home or primary residence. And each time they look at it, they say, okay, but, and they tack on another rule and another, okay, but we're going to slow you down. Okay, but. So we absolutely can buy a property that will eventually be their primary. Now, I want to talk about that vacation scenario because it's been so popular here recently. And again, Palm Springs and Palm Desert, everybody in Oregon is flooding to Palm Springs and Palm Desert from what I can tell. So when we buy that vacation type property in the sun, if they put it into vacation rental mode, that's fine. They do not have to have a full-time tenant. Most of these end up being vacation rentals. And the IRS did come out with some very clear guidance for vacation rentals, because people kept asking, well, how much can I use it myself? And the IRS finally came out with guidance, and here's what the guidance says. The Palm Springs property, Palm Desert, wherever, they have to play a game, I'll call it, for 24 months. They do have to have, well, very little rental. They have to have 14 days of fair market rent in the first 12 months and 14 days of fair market rent in the second 12 months. So they can't load it all on 28 days in the first 12 months and then nothing. No, it's got to be at least 14 in the first 12, 14 in the second 12. Naturally, these tend to rent far more than that. But that's all that the IRS requires in the entirety of the year, 14 days. Now, personal use, the question that our client always asks is how much can they get down there themselves? Well, unfortunately, it's quite limited, but only for 24 months. And then all of these rules go away. And what the guidance says is that our client can use the property 14 days vacation in the property, 14 days in the first 12 months and 14 days in the second 12 months. So admittedly, that's not much. But if they're willing to play that game, they will then ultimately, 2 years out, they'll have their own second home or primary residence in that destination where they want to be. A couple of things. I should say that, first of all, work days. So if they are in the property to work on it, they can get some extra days with work days. Those don't count. We're counting only personal use vacation days. That personal use vacation, it's not just our client in there. So if they wanted to allow a friend to use the Palm Springs property for free or below market rent, that's coming out of our client's 14 days. If family members stay there, close family, siblings, parents, children, if they stay there, even if they pay fair market rent, which they wouldn't, but even if they did, it's still coming out of my client's 14 days. So that personal use is broadly defined. It isn't just our client in the property, but it's a very popular strategy, particularly for your client that's, many of my clients are in their 60s, 70s, and 80s. And so something like that is attractive to them. Okay, moving on. All right, deadlines. We have to talk about these. And having been in this business now for, oh dear, almost 3 decades, I never imagined that happening. But here I am still. And I have, I won't say I'm a cranky old woman, but I certainly have become opinionated. And I have, and judgmental a little bit. And so there is the good deadline, 180 days. Now, when the relinquished property closes, that's when the clock starts ticking. It isn't when you take the listing. It's not when you get a buyer under contract. It's at closing. With an exchange company's paperwork at the closing table, oh my gosh, they have got to have an exchange company at that closing. And I may be getting ahead of myself, but I have had several questions in the last 2-3 weeks about, well, why do I have to have you? Do we need you? And my answer to a fellow recently was, well, yeah, you do, because it's the rule. It's just the rule. kind of a lame answer, but they've got to have an exchange company participating in that closing, or they don't have an exchange in any case. With an exchange company's paperwork at closing of the relinquished, 180 days to close on the replacement property. Well, it's almost 6 months, not quite 6 months, almost. It's 180 days to close on the replacement property, which frankly is seldom an issue. New construction, sometimes we get a little stressed. And we have one that's failing right now because they wanted to buy something in Arizona, and the zoning and environmental and on could not be worked out within the 180. But generally the 180 is more than enough time to wrap up the exchange. That's the good deadline. There is then the bad deadline, and I mean the bad deadline, 45-day deadline. They have only the first 45 days of the 180 to identify to us their replacement property. We do provide them with a form for that purpose. We'll talk about this a bit more in a moment. We provide them with a form. We try to make it easy. They absolutely must hit that day 45 or their exchange is done. So the deadlines are carved in stone. I mean, without a federally declared disaster. And actually, we had a client this fall who did not like and did not want any of the 3 on their list. And one of those properties had been in California, where the fires were located. And the year earlier, when there were the fires in California, the IRS did grant extensions of filing deadlines, and our clients in that year got extensions. So the client this fall, we said, well, let's wait and see. Let's wait and see if the feds come out with a disaster declaration. Well, we checked here early this month, and it never did happen. It did not rise to the level of a federal disaster. So my client stuck with these deadlines and frankly isn't buying any of the 3, so has a failed exchange. So the deadlines are carved in stone, short of a federal disaster, heaven forbid. The identification rules, we need to talk about these a little bit. The one that 95% of our clients utilize is this 3 property rule. And the form that we provide has 3 blank lines, and they may list up to 3, the one they want and 2 backups. Of course, in this current market, those 2 backup properties, if the first one falls out, the second and the third probably aren't available. But this is in the generosity of Congress. They allow our clients to list 3. The one they want backups. Oh, oftentimes we have a client selling 1 property to buy 2. Then it's going to be the 2 they want and 1 backup. Or if they're buying 3, it's the 3 they want and no backups. May I also say, from a broker's perspective, as a business person, and that's spotting the opportunity for exchange. Remember, in a 1031, there's a relinquished and a replacement. So as a broker, if you're trying to make a living in this business, the ability to spot that opportunity might put you in a position of working with them on the replacement property in a second commission. Also to say that truthfully, about 1/3 of our files, our clients aren't just selling 1 to buy 1, they're selling 1 to buy multiples. They're selling multiples to buy 1, bigger, better. So if you're the broker on both ends, about 1/3 of my exchanges, you would be looking at 3 or more commissions. So that spotting the opportunity is critical for your client and frankly for your own business reasons. So 3 properties on the list. When they put 3 properties on the list, those properties can add up to $1 gajillion, however much that is. We do not care about valuation when there are simply 3 on the list. The 200% rule, utilized only about 5% of the time. And an example, we had a client selling a property here for $620,000, and they were going to take those dollars off to Alabama. And they thought they could pick up maybe 4 or even 5 replacement properties in Alabama, considering the price point. And so, well, then 3 property rule wasn't going to work for them. They needed to list more. So they had a sale again at $620,000. The 200% rule says you can list as many properties in Alabama as you want, as long as the aggregate fair market value of all of those 8 properties, for instance, as long as the fair market value of all of those properties in Alabama does not exceed twice the gross sale price. We're looking at the gross, $620,000, not net after your commission and closing costs. So the gross, what is that, 1.24. They could list as many properties as they want, as long as they don't exceed $1.2 million, basically. The 200% rule, you only utilize when clients are selling a large property looking to buy smaller stuff. And that happens from time to time. But for the most part, as I said, our clients are really using 1031 to go into a bigger or better replacement property. So then they're looking at the 3-property rule, where those 3 can add up to $1 gajillion. I want to talk also about the technical requirements of that identification. As I said to you, we provide a form. Why do we provide a form? Because your client is required to identify in writing. And when we get near day 45, and I'm on the phone with the client, and the client is, well, Toya, you know what I'm buying. Why do I have to do this? Well, it isn't a verbal identification. It has to be in writing. So if they would just please get that form we provided several times and fill in the addresses, pretty simple, in writing. Number 2, it has to be signed. How do our clients get into trouble? Well, my client sits down at the computer Saturday evening, because the deadline is Saturday, and that's fine, and he types out an email. And he types 3 street addresses, and he types his name at the bottom of the email. And a typed name on an email, that's not a legally binding signature. DocuSign would work, but we're talking an email here. And by the way, where is that form he had on Thursday that we provided that had a signature line clearly with his name on it and one for Mrs. Dr. So-and-so? The client was a doctor. Oh, maybe that was recent. The client wasn't going to use that form. And anyway, it has to be signed. So we do have in one of my files a piece of paper, it's an email, unsigned, but we will let them discuss that with the auditor if they ever have to. Third requirement, it has to be sent to a party, to the exchange, and that would not be you, their broker, nor their attorney, nor their accountant. It really has to come to the exchange company. Fourth, of course, it has to be within the 45-day deadline. And fifth, and this is where our clients get into trouble most often, it has to be unambiguous. So I had a client who gave us an ID recently, out of the Tri-Cities, and it said, at the corner, let's just say, at the corner of Brand and 5th. Which corner of Brand and 5th? Most intersections have 4 corners. So is it the northeast, southeast, northwest, southwest corner? He had neglected to include that information. The good news is we saw that before our deadline passed. As we got back to the client and asked him to be more specific about which corner he was talking about, unambiguous. Oh, they gave us a street address, 2444 Main Street. And that's it. Well, how many 2444 Main Streets are there in Oregon, let alone the United States of America? So I happen to know the guy was shopping out in Washington County, but this ID came in over the weekend. We don't see it until day 46, day 47. It's too late to fix. So I think that's ambiguous. Which city are we talking there? Although I will tell you, one of our clients identified a property and they gave us the street address and city, but they left out the state. And a team member came in and said, Toya, take a look at this. And I said, well, let me just turn to my computer here and Google La Jolla. And I can report that La Jolla, there's only one in the whole country. So we did not have to bother them with adding California to the identification. So unambiguous. If they're buying a fractional interest, many times our client isn't buying a whole. They're going in on a deal with another buyer, 50-50 or 10-90 or whatever the percentage is. They do need to provide the percentage. And one last thing, if they're wanting to buy a condo, yeah, they actually have to give the unit number. They can't just say the next available condo in this building. No, it has to be unambiguous. So that's really why does any of this matter? Because audits. The audits are almost entirely around compliance with day 45. We only hear from clients 2 to 4 times a year who are being audited. How do we even know they call? And they say, oh, Toya, can we get that piece of paper out of your file? And we provide it to them. And it's been countersigned by us as to when we received it. So they take that paper off, hand it to the auditor, and we never hear from them again. The risk of an audit on a 1031 exchange is slim to none because it's a tax deferral. The tax bill didn't go away. It's just waiting in the next property. So the state, the feds don't tend to look. California goes after 1031, and New York, but no other state currently. And so it doesn't really get looked at. They're only looked at if their tax return is pulled for audit for some other reason. The auditors are told if there's a 1031 on there, get the taxpayer to prove compliance with day 45 because results of a study out of California revealed the games that people were trying to play around day 45 because it's too short. That's why it's a bad deadline. Only 3 properties. They're terrible rules. But those are the rules we have to live by. And more rules. Rules of reinvestment. I'm going to pick up the pace a little bit here. they have to use the net cash from the sale. So all the cash from this, if they don't want to pay any tax at all, they'll take the net cash from the sale after your commission and escrow and closing. They take that net cash and utilize all of that toward the replacement property. Reinvest the cash. Second rule, not as well understood, not well understood at all. Second rule, if the property they're selling has a mortgage against it, of course that gets paid off at closing. If that property has a mortgage, if it's what am I saying? If it's a free and clear property, they just need to spend cash. But if there's a mortgage against the property, then there's a second rule of reinvestment, that they are to get a replacement loan, replacement debt, equal or greater to the payoff on the old property. Reinvest the cash, and as I put it, reinvest the debt. So if they're selling, for instance, a rental property, they pay off a loan of 100, and they've got 250 of cash, and they want to go out and buy a new property for 250,000 free and clear. They generally see that as just perfection. This is just lovely. And you know, my clients, again, older, they don't want debt. They'd like to be debt free. 1031, it's not a good way to get debt free because there is that requirement for replacement debt. One exception, they don't want to get a new loan for 100. Then cash added in. If they have 100,000 of cash laying about, as I put it, their cash of 100, the 250 we're holding, put that all in on replacement. They sold at 350, they bought at 350. That's what 1031 is all about. They're to go back into the American real estate economy, and that's why it's been in the tax code 99 years, is because we keep explaining to Congress, and I go back twice a year to lobby to explain to those folks back there why it's a good thing for America. If they're into the American real estate economy, rental, commercial, or land, and they sell for 350, pay the tax. Ooh, don't want to pay the tax? Then drive back in to the American real estate economy, be it land or commercial or rental, we don't care, that they need to go back in at 350. If they only go back in at 250, free and clear, well, as I put it, they've shorted America $100,000, and we're going to make them pay tax on that, even though the 100,000 was paid to the lender, not to our client. It was the bank's money, not theirs. So they really do need to get the best result. They're selling at 350 net of commissions and closing. They're buying at 350. Now, partial exchanges. They don't find a property at 350. They find a property at 349. Perfect. They'll just pay tax on the $1,000 they fell short. So we have a lot of partial exchanges where they don't quite come in at the sweet spot. You know, they're going to be long or they're going to be short. If they come in short by a few dollars, it's not a big deal. It's still a great exchange. Third requirement is that they can only get like-kind property. You know, once in a while, our client's buying a ranch and it comes with equipment of $180,000. Well, that equipment isn't real property, and so that portion of the purchase, personal property equipment, that's going to be taxable on that they receive, but that doesn't happen very often. Now, to be efficient with our time today, on this page are some things to be, as a broker, watching for. And you'll see it in the checklist for the client. And if you go to our website, you'll actually see a broker agent checklist there, which I did not provide today. But the broker agent checklist is just one page, and these items are on that checklist for you, the broker. Related party transactions. Replacement property. If they're supposed to get out there with you and shop around for replacement property. If they are inclined to go to grandma and they want to buy her property from her, we need to talk to them. I would say basically they're not permitted to buy from a related party. Selling to a related party is fine. It's buying from a related party. You basically can't do it. We've had some high-level case law in the last few years. So your client needs to be out with you shopping the open market to buy it. Now, we're talking close family, parents, grandparents, children, grandchildren, siblings. So aunts and uncles and cousins are not considered related. Well, don't tell them, but they're not technically related under the IRS law. In-laws, ex-laws, outlaws, not related. It's close family, and it is basically prohibited. Once in a while, we can find a thin exception to get it permitted, and this is where your client would really have to talk to us about these points so that we can explore, is there some way to do it? Generally, there isn't, but once in a while. Secondly, they have to have an exchange company. It's just the rule. And what does the exchange company do? What is our job? Two things. Our paperwork in the closings for the relinquished property, for the replacement property. If they sell or buy something without an exchange company's participation, without an exchange company's documents in the closing, That property is not part of an exchange. They simply have to have us, it's the rule. We're there for the paperwork. Secondly, and we send our paperwork to the title company, wherever in the United States that is. And your client will generally just sign our paperwork right at closing and try to keep it easy, just signing everything all at once. So we're there for the paperwork. Secondly, I think you know, they can't take their own money. So yes, their funds do have to come to us, and they sit in a bank account. The way we handle it is a bank account segregated for your client, their name, their social. It's in that bank account pending the purchase. So we're here to prepare paperwork, and we're here to hold their money. Now that is little of our day. Most of our day is on the phone as a resource. I mentioned that, didn't I? A resource to you with the what can I do it and have I seen it and what ifs. But they have got to have somebody like us participating. Third, cash out. They cannot get cash out during. And one of the questions we will ask your client before we ever set up an exchange, if they will give us 10 or 15 minutes, do you want some cash out of your sale? And I will tell you maybe a third of the time they do, perhaps to pay off credit card debt or a car, or to run off to Vegas with a few dollars. Paris, I prefer, but maybe Vegas. Oftentimes they do want cash. So then we need to finesse. And what do? We try to arrange with the escrow for the sale, relinquished property. We want that escrow officer to cut them a check directly out of that closing for whatever they want. Taxable always on whatever they take. Always taxable, always, no matter why they're taking that money, it's always taxable, but they at least get it right as the sale closes, and we take only the monies they want us to hold. Because then once we're holding monies, oh my goodness, here, use of funds. There's all kinds of rules about what we can do with their money. We basically can only use it to buy the new property. Yes, we can pay the earnest money deposit. We can pay the commissions and closing costs that incur on both the relinquished and replacement. That's it. Oh, and remember, if they pay off a loan of 100, they need a new loan of 100. They need a new loan of 100. Technically, we cannot pay loan fees. They are not, I'm just going to leave it at that. Loan fees are not eligible for payment out of the exchange account. They're going to have to come out of their own pocket for that. So those are some critical things that get people unhappy if they are not aware, and that's hugely why we have that checklist for them. Now, moving on to reverse exchanges. And boy, this has been reverse exchange month, a week. I typically will get, and this is not an exaggeration, maybe 5 calls a day to at least discuss, well, Toya, we're out there shopping. What if we find something we really want to buy? The IRS will actually let people buy the replacement property first. They will, and then sell the old property later. But they will not let your client be the actual owner of both. Oh, they cannot own both of those properties. Yes, you can buy that property, but you cannot be the owner of both. Well, that kind of sounds crazy, doesn't it? What do they mean by that? Well, what happens in a reverse exchange? One of the properties, the replacement usually, the relinquished sometimes, one of those properties ends up being parked with the exchange company. We become the owner. Now, what we've been talking about up until now are forward exchange. First they sell, then they buy. Our fees for those are quite nominal, in my opinion, in the grand scheme of things. They're flat rate. They vary just a couple $100 between one company and another, from what I understand. I obviously don't really know. But you can figure your client's fees for a typical exchange, residential. Ours are $1,100 all in, both the sale and replacement, sell one, buy one, really $1,000 to $1,500, I don't know. So flat rate, but now that was pretending. Our paperwork in the closing, we're pretending to sell their relinquished. We're pretending to buy the replacement. Well, not in a reverse. In a reverse, we are the true owner of one or the other. Now, while we own, we do lease it back to the client. So they will have full control of the property. They collect the rents. They service the mortgage. They'll have full control. But we are technical owner, and for that reason, our fee, instead of our fee of $250 to buy, our fee starts at $6,000 and goes up. Because we're an owner. It goes on our tax return, and my CPA charges me, and on and on and on. They're very much more complicated. There's no cookie cutter. Every reverse exchange is custom designed to whatever is going on with your client. So they cannot be the owner, we have to be. The deadlines, the same as they are for a forward exchange, that when we become the owner of a property, we can only hold it 180 days, during which time you've got to get their old property sold and closed. Deadlines are the same. What do I suggest to people? instead of a reverse exchange, instead of paying us $6,000 or whatever, go to the seller of this perfect property and offer them $6,000 additional earnest money. If they must, make it non-refundable. Is there some way to tie up that property and buy patience out of that seller? Better to pay the seller a little extra money than to, have to pay us these fees. Plus, there's some extra transactional costs that I did not mention. So the reverse exchanges are pricey. Beg, borrow, or steal an extension out of the seller of the replacement while you get that relinquished, sold, and closed. We will do a reverse exchange when these 3 criteria are in place. Number 1, it is the to die for replacement property. Nothing else will do for your client. They simply must have this property. 2, the seller can't be bought. The seller will not wait. No, there's 2 buyers behind you. I can close in just a few weeks. I'm going to them if you can't close now. So seller won't wait. Number 2. Number 3, there's enough gain in the property being sold to justify the higher expenses of a reverse exchange. So for certain, I feel that they've got to have gain in the old property of at least $100,000, or it just doesn't pencil to pay all these higher fees. If they have gain of $40,000, it wouldn't make any sense at all. So in a nutshell, that's the reverse exchange. Now, improvement exchanges. So what's an improvement exchange? And I would say go back to the reverse exchange. I will have 5 conversations a day myself. Those conversations will ultimately turn in typically to only 5 a month. I think we're going to have a few more than that this month, but typically only 5 a month will ultimately go the route of reverse exchange, because usually you can beg, borrow, or steal patience out of the seller of that target house, or your client lets it go and moves on to something else, keeps shopping. Improvement exchange. Here's how this comes up. Your client told you that they wanted a turnkey 4 unit, and you're not finding that, mostly because they don't exist. And if they do exist, they don't even get on the market. They get bought before they ever show up on the MLS. So they want a perfect 4 unit, and you're not finding it, but what you have found, there was a 6 unit. And it's a bit tired, and it needs, let's say, $100,000 of work. So your client is asking us, Toya, can we use the money in the account, part of it for the purchase down payment, and then hold back $100,000 to do the work on the 6 unit? And the answer is yes. But now here's the requirements. May sound a bit familiar. We can use that $100,000 to make improvements to the property, but your client cannot be the owner while the work is taking place. Phooey. So here we go. Typically, Butler, we've set up an LLC and we're the technical owner. Seller deeds it to us, not to the client. And now we are the owner and we have this $100,000 and we start paying for improvements. Again, we lease it to your client. They collect the rents. They're servicing the mortgage. The lender will go along with it. That's a commercial loan when we get above 4 units. The lender will let us be the temporary owner of this property, even if there's a loan, not a problem. I mean, there's work to be done, but it can be achieved. We are the owner while the work takes place, and we only get 180 days. So I should say this, if our client is trying to get 100,000 into the property within the 180, and we get to the 180th day and we've only done 80,000, it's still a good exchange. It's still a good exchange. It's a great exchange. It's just taxable on the amount we fell short. I will also say this, that I have never had an improvement exchange where at day 180, we had any money left in the bank. We had spent all of the 100,000. It may be that only 80,000 of that got converted into real estate, and it does have to be converted to real estate. Prepayment doesn't work. But we paid the bills. We don't inspect the job site. We don't really know if that concrete got poured or not. But we will never have any money left over. But it's up to our client and their accountant to figure out how much of the work really got done within the 180. It's not a failure if they don't get it done. They just have a partial exchange to the degree the work did, in fact, get accomplished there. So in my last few minutes, here we are on questions, but I do have a few things. So please, if you have any questions, put those to us and we'll get them answered for you. But in our last few minutes, I want to talk about audits. Again, I said earlier that it's slim to none, but we did meet last year as an industry with the IRS, and we met with California, and they did each of them disclose what they're looking for if an exchange were to be audited. And again, it's not the exchange that triggered the audit. It is the something else on that tax return that got the look-see. The IRS has told us that they are looking for boot, any cash, of course, that your client took, any debt relief, if they don't get enough replacement debt, boot and taxable, any equipment that they receive from the purchase of the ranch. They're looking for boot. Secondly, they're looking at that 45-day deadline and compliance, absolutely. And third, they're looking for related parties. I should say this about related party. Sometimes your client says, well, grandma has a different last name, so how will they ever know? Well, actually, when the accountant completes a tax return and reports the exchange, there is a form to report the exchange. And one of the questions is, did you engage in a related party transaction? And yes and no are our only two options there. So your client will have to self-disclose that it was related, even if the last names were different. So the IRS is going after boot, they're going after the 45-day deadline compliance, and they're going after related party. California. Oh, yes, Katie.
There's a comment that says not qualified, correct?
Not qualified. I'm not quite sure what we're referring to there.
To confirm the client lives in the personal resident for less than 2 years and is, are you trying to scroll down and see the rest of it?
Oh, it's a long question. Sounds like the client has a primary residence. You know, they have to live there 2 out of 5 to get the tax-free treatment. So if they've lived in the house less than 2.
Yes, for less than 2 years.
Yeah. So if it's a primary residence, they've lived in it 18 months and they're now moving already, it doesn't qualify. It's non-qualified. It's not a rental. It was in personal use mode at the time of sale. And they don't get primary residence treatment either. So if they've not lived in their full amount of time, they are going to be paying tax on whatever gain accrued in the 18 months. With this exception, I will mention, again, as a real estate attorney, not tax, their primary residence, if they are moving out of that home because of job transfer that moves them a certain distance from the house, then they can sometimes get a proration on that tax-free treatment. But if they're just moving to a new house because it's bigger, better, they like it, then they're going to be taxed on the gain in that house over the 18 months, if that were the length of time. Not qualified, darn. California audits, because so many of our folks that we're working with are coming up out of California and buying here. California is going after 1031, and they are not nice about it. So California is looking for 5 things. First, boot, like the feds, any cash they got, debt relief, taxable. The 45-day compliance, absolutely. They're looking also for related party. They're also looking for partnership breakups, which we did not talk about here today. But if you have a client perhaps selling a commercial property in a partnership or LLC, they're breaking up at the time of sale. California is all over that, and for reasons beyond the scope of this discussion today. Partnership breakups at the time of sale. California is looking into that. And then the 5th thing that California is going after are refinances of replacement properties immediately after they buy the property. So your client's selling a property free and clear for $1 million, and 1031 says they got to put $1 million back into the replacement. They don't want $1 million back in there. They want some of that cash to themselves. They can. But California has been finding that people, before they even become the owner of the new property, have already been to the bank and submitted a loan application to refi even before they own. And California is not thrilled with that, and they have disallowed those types of exchanges. Yes, Katie, another question?
Yes, sellers may now postpone tax on gains by reinvesting in opportunity zones. How do the benefits compare with 1031 exchanges?
So the question about, instead of doing a 1031, taking the gains and putting those into an opportunity fund. I know the properties are in zones, but our client would have to find a fund to put their money in. And there's a couple, well, there's one advantage for sure. So if my client is selling $1 million property with 200,000 of gain, if they can find a fund, that's the bigger issue right now, is can they find a fund? They're a little hard to track down. I don't even know how to find them exactly. But if they sell for $1 million with gain of 200, in an opportunity fund program, they just have to reinvest 200, the gain only. That's fabulous. If they're going 1031 route, they got to go back in all in at $1 million. So an opportunity fund, they only reinvest the gains, not the basis dollars. 1031, it's all of it. There is a negative to the opportunity fund. We don't see these used very often, I think, for this reason, that when they invest in an opportunity fund, first of all, there might not be cash flow in the first period of time, because usually those are development projects. There may or may not be income off the property leases. So they might not see much income initially. But secondly, the period of investment to get the best tax deal off of an opportunity fund, I think they're into that thing for about 10 years. And I'm not expert on opportunity funds, but we have seen this as an alternative. 10-year investment. Most of my investors, they don't want to be tied down for 10 years. they will certainly buy a property and hold for 5 or, 6, 7 until they find a good opportunity, but they're not wanting to be tied in for a full 10 years. So it's too long an investment period for most of my folks. So we've only seen maybe 3 of our clients go that route, 3 in 2 years that have turned toward a fund rather than doing the 1031, because that 10-year time frame is a bit of a problem for them, if you will. Any other questions? I think we're at our time. I just want to wrap up with 2 comments and kind of just remind you again, what do I want you to take away from this presentation today? First and foremost, the ability to spot the opportunity for an exchange. Residential rental, commercial properties, or land held for investment in whole or in part. Spot that opportunity. It will put you in a position, if for no other reason, to help your client achieve their personal goal, business goal, and you might even pick up another commission. And then lastly, do know that we are a resource. It's the fun part of our work. And I and a couple of others are attorneys and there's paralegal. We in our office there's no billable hours in there, although we do have those degrees. We are like every other exchange company. We're there to just talk and educate. So time on the phone with us is just education, and there's no fee, just flat rate fees if and when they do an exchange. We are absolutely a resource for you. Do not hesitate to call.
One more question.
Oh, here we go.
If an owner directly exchanges investment real property for another property without accommodator, can it qualify as a 1031 exchange?
So if they do an investment, sell an investment property, go into another property, they're doing what Congress wants them to do. But if there's no 1031 company involved, they are absolutely taxable on the sale. And the accountants know that there should be an exchange company's name showing up on settlement statements. So even though they're doing what Congress wanted them to do, they're selling an investment, they're buying an investment, absolutely prohibited for 1031 because they've had control of money and they don't have our paperwork, so it just fails. Okay, well, with that, it was my pleasure being here today. Thank you. And well, that was fun. Start to my day. Thanks, Katie.
Thank you so much. Have a good day, everyone.